Welcome back to the deep dive, everybody. Today we're doing something a little bit different, something pretty cool, I think.
Yeah, this is exciting. Looking forward to it.
In the past, we've done some really in-depth examinations of different strategies for options trading.
Yep.
We've talked about covered calls, cash-secured puts, iron condors, all that fun stuff. But today, we're kind of stepping back a bit, taking a look at a different approach, one focused on stocks themselves.
Exactly. We're going to be exploring the fascinating world of Nicolas Darvas and his book, You Can Still Make It in the Market, a book that you brought to our attention.
I did. Now, before we dive in, I just want to make sure everybody's on the same page. For this deep dive, we're drawing primarily from Darvis's own account of his experiences, as detailed in his book. He doesn't hold back. He really lays out his journey, his thought process, even his mistakes, all centered around this really unique approach he developed, what he called the box theory. And just to give everyone a little bit of context, Darvis was writing this back in the 1970s, so we'll be talking about real-world market scenarios from that era.
Yeah, and it's fascinating to see how someone from a completely different background, a dancer no less, approached the market with such a fresh perspective, unburdened by those conventional Wall Street assumptions. And that's what makes this deep dive so interesting, I think. Even though it's from a different era, the core principles that Darvis outlines, they still resonate today.
They really do. And that's our mission here, right? We want to break down the core of this box theory, understand how it works, how it's applied, and what insights we can glean from it, even in today's market. And
Yeah.
we don't want to overload anyone with information. We just want to get to the heart of this historically successful, rules-based investment strategy.
Absolutely. Think of it as distilling the essence of Darvis's approach so you can see if it might resonate with you and your investment philosophy.
So without further ado, let's get into it. Let's set the stage here. Darvis starts his journey in the stock market while he's traveling the globe as a professional dancer. Talk about an unconventional start.
Yeah, imagine that, from stage lights to stock charts.
He gets intrigued by the stock market, starts dabbling a bit,
Yeah.
but quickly becomes disillusioned, frustrated even. He calls out all the mumbo-jumbo surrounding traditional analysis, earnings, dividends, asset values. It just wasn't clicking for him. He wasn't seeing those insights translating into profits.
Yeah, and that's a really key insight right there. Sometimes all that expert talk, all the fancy metrics, they don't necessarily guarantee success in the market. It can be overwhelming, confusing, especially for someone coming in with a fresh perspective. And Darvis, he recognized that.
He did. So he decides to take a different path, starts developing his own method, essentially through trial and error, learning from his successes, but more importantly, learning from his mistakes. No fancy theories, just real-world experience shaping his approach.
A true do-it-yourself investor.
Absolutely. And this leads us to a really pivotal moment in his journey. It's the fall of 1974, and he gets invited to speak at an investment seminar in London.
Wow, imagine that, a dancer speaking to a room full of seasoned investors. That must have been quite a scene.
I know, right? So he's preparing for this seminar, and he realizes he needs a way to visually explain his thought process, his system. He wants to show them how he sees the market. Not just talk about it, but actually show them.
So what did he come up with?
He comes up with this idea for a simple, compact diagram, something no bigger than a postcard, for each stock he's analyzing.
A postcard. That's a pretty unique visual.
It is. He wanted to distill all the essential information needed to make a decision, buy, sell, or hold, right there on that little card. And this, my friend, was the birth of what he called the DAR card.
The DAR card, I like it, has a nice ring to it. And this DAR card, it was essentially the visual representation of his box theory, right?
Exactly. The DAR card was the canvas, and the boxes were the key elements of his analysis. It was all about looking for patterns in the stock's price movements, but in a very specific, almost geometric way. Think of it as identifying periods of consolidation, these boxes, followed by potential breakouts.
Okay, so walk me through this box formation. How do you actually identify these boxes on a chart?
So imagine a stock price is trending upwards. It hits a new high, and then for at least 3 consecutive days, it doesn't go above that high. That high point becomes the top of the box.
Makes sense. So it's kind of like a ceiling, a resistance level.
Precisely. Then, after hitting that high, the price pulls back, goes down a bit, but finds a low point that it doesn't go below for at least 3 days. That becomes the bottom of the box, like a floor, a support level.
So you've got these clearly defined boundaries, a range within which the stock's been trading.
Right. Now, here's where the buy and sell signals come into play. If a stock is trading within its most recent or topmost box, and the overall market trend is up, Darvas's rule was simple. Hold. No need to do anything, just sit tight.
Okay, that makes sense. Don't disrupt a winning trade. But what about the buy signal? When does he actually pull the trigger and buy a stock?
The buy signal is triggered when the price breaks out above the top of that topmost box. That breakout is a sign of strength, a potential continuation of the upward trend. And here's a key point. He immediately places a 10% stop-loss order below his entry point.
Smart, protecting your capital right from the start.
Absolutely. Risk management is crucial. Now, on the flip side, let's talk about the sell signal.
Yeah, when does he decide it's time to take profits and exit a trade?
So let's say a stock has been trending up, forming these higher boxes. But then the price drops below the bottom of the previous box, the one right before the current topmost box, by more than 5%. That's his sell signal. He called this the shaded danger level.
Interesting. So it's not about just any drop below a box. It has to be a drop below the previous box and by a significant amount.
Exactly. It's a sign that the prior upward momentum might be weakening. And he had this fundamental rule. If a stock wasn't actively in its topmost box during a rising market, there was no reason to buy it or even hold on to it.
So he was really focused on those stocks that were showing clear upward momentum and breaking out to new highs. He wasn't interested in trying to catch falling knives or betting on turnarounds.
Right. He wanted to ride the wave, not fight against the current. And one of the early examples he gives in the book is his experience with National Semiconductor back in early 1975.
Let's hear it. How did this box theory play out in a real-world scenario?
So he starts observing National Semiconductor, and he notices it's forming these distinct boxes, each with a higher price range than the last.
Classic uptrend.
And here's another thing: he looks at volume. He sees that the volume is increasing as the stock moves up. That's confirmation, right? That surge in trading activity often signals conviction behind a price move.
Makes sense. It's like more and more people are jumping on board, fueling the upward trend.
And true to his system, he buys after the price breaks out above a box, sets his stop loss, and later sells when the price drops below a subsequent box. Now, it wasn't always smooth sailing. There was a point where National Semiconductor had a dip, a period of volatility.
Yeah, that's bound to happen, right? Even in an uptrend. How did he handle that?
This was a test of his discipline, his faith in his system. He didn't panic and sell. He stuck to his rules, and it paid off. The stock recovered and continued its upward climb.
That's a really valuable lesson right there. Sometimes the best course of action is to simply trust your system and ride out the short-term fluctuations.
Absolutely. Patience and discipline. Two key takeaways from that experience. Now, it's important to remember the overall market environment at the time. We're talking about the bear market of 1974.
A challenging time for any investor.
Many well-established blue-chip companies were trading at what seemed like bargain prices. But Darvas, he shifted his focus away from those seemingly safe stocks that were languishing.
Interesting. So in a bear market, he's not looking for value plays. He's looking for something else.
Exactly. He starts paying close attention to emerging growth companies, the ones showing upward momentum despite the overall market downturn.
He's betting on the disruptors, the companies bucking the trend.
Exactly. He really hammered home this point. Watch what stocks are actually doing, not what people are saying about them, not even what their fundamentals might suggest. The price action, that was his primary source of information.
So he's not completely dismissing fundamentals, but he's saying price action comes first.
Right. It's about seeing evidence of real buying pressure, not just potential. And he has this great example with Hughes' tool that really highlights the importance of sticking to his rules, especially the use of stop losses.
Oh, yeah. Tell me about that.
So he buys Hughes' tool based on what appears to be a breakout. But then the stock unexpectedly reverses and falls below his entry point.
Ouch, that's gotta hurt.
It would have, except he had a stop-loss order in place. He gets taken out of the trade with a small loss, but it could have been much worse. He acknowledges his mistake, trying to anticipate the market's next move instead of letting his system guide him.
Another reminder that even experienced investors can make mistakes, right? The key is to learn from them and reinforce that discipline.
Absolutely. And to contrast that, he talks about his experience with Houston Oil and Minerals. This one highlights the power of patience.
Okay, let's hear it.
He's watching Houston Oil, carefully observing as it forms those boxes. He doesn't jump in prematurely. He waits for that clear breakout signal. When it finally comes, he buys, sets his stop loss, and lets his system work.
And what happened?
Houston Oil takes off. It keeps forming new, higher boxes, leading to some substantial profits for Darvas. It's a testament to the effectiveness of his approach. trusting the price action, and having the patience to let the trade play out.
That's a really compelling example. So we've talked about Darvis's system, his experiences, but I'm also curious about his interactions with other investors. Did he ever discuss his approach with others?
He did. He recounts these fascinating conversations with fellow hotel guests, Mr. Falcucci and Mr. Klein, about their investment portfolios.
What were those conversations like?
Well, their portfolios were full of well-known, safe blue-chip stocks, a very diversified approach, a stark contrast to Darvis's concentrated, momentum-driven strategy.
Interesting. And how did they react to his box theory?
Darvis was actually quite critical of their reliance on stock tips and their focus on buying fundamentally cheap stocks. He pointed out that these types of stocks could just sit there for years or even continue to decline.
So he wasn't a fan of the buy low, sell high mantra?
Not in the traditional sense. He believed that being cheap didn't necessarily guarantee future price appreciation. He wanted to see evidence of buying pressure, upward movement.
That makes sense. He was all about riding the momentum, not waiting for things to turn around.
Right. Now, in the appendix of his book, he actually lays out the key principles of his system. It's a concise summary of his approach.
I'd love to hear those key principles.
So first off, he emphasizes the importance of investing in companies in new and developing industries, the ones with strong growth potential. He wasn't looking for established giants. He wanted the disruptors, the innovators.
Makes sense. Those are the companies that can really take off.
He also stressed the need to make sure the overall market trend is favorable and that the industry group the stock belongs to is also performing well. A rising tide lifts all boats, as they say.
So it's not just about picking the right stock, it's about picking the right stock at the right time in the right sector.
Exactly. He also paid close attention to stocks rising in price on high volume, confirming that buying interest. And then, of course, the application of the box theory itself, looking for that sequence of rising price ranges or boxes.
Right, those visual cues that signal an uptrend.
And he was very specific about his entry point, waiting for that first penetration above a box, followed by a continued move higher, always with a stop loss in place. No chasing stocks that have already run up significantly.
Discipline, discipline, discipline. It's a recurring theme.
It is. And he also made some really interesting observations about the emotional side of investing.
Oh yeah, that's a big one. How did he address that?
He talks about how investors often hold on to losing stocks for too long, get swayed by rumors, let fear and greed dictate their actions. And he strongly advocated for the need to have a discipline system to remove emotions from the equation as much as possible.
Easier said than done, right? But that's the ideal, to let your system guide you, not your emotions.
Exactly. And he even went so far as to say that any system with clear rules, especially stop losses, is better than trading without a system at all.
I think there's a lot of wisdom in that. Having a framework, a set of rules can help you stay grounded, especially in volatile markets.
Now, one more interesting point he brought up was that the dark card could also be adapted for short selling.
Oh, really? So not just for buying stocks, but for potentially profiting from price declines as well.
Right. By reversing the buy and sell signals, you could potentially apply the same box-based approach to short selling.
That's pretty cool. It shows the flexibility of his system.
And finally, the book concludes with a test yourself section, where he lists some top-performing stocks from 1976 and challenges the reader to analyze their potential future performance using the box theory.
It's like he's saying, okay, here's the framework, now go out and apply it.
Exactly. So to wrap this all up, Nicolas Darvas, the dancer-turned-investor, developed a truly unique and successful approach to the stock market. He called it the box theory, a visual, rules-based system for identifying trends and managing risk.
And his story is a testament to the power of independent thinking, discipline, and trusting your system.
And for our listeners, even though Darvas was trading back in the 1970s, the core principles he outlined are still relevant today. Identifying trending stocks, setting clear entry and exit points, managing risk with stop losses, those are timeless lessons.
Absolutely. And his emphasis on observing what's actually happening in the market rather than getting caught up in predictions or opinions, that's invaluable advice for any investor.
So here's a final thought for you. How might Darvas's principles be applied to today's markets? What new industries might be exhibiting those box-like patterns, signaling potential future growth? It's something to think about as you explore your own investment journey. Thanks for joining us for this deep dive.